Hello, welcome to the Money Game, where we make actionable predictions about the big stories shaping the world today. My name is David Wu, a former top Wall Street investment strategist, now making the best of Wall Street research available and accessible to all. If you're interested in making money, you're in the right place. If you're not, this program is designed for anyone who's just interested in learning about what makes our world tick. If you find this podcast useful, please subscribe to my YouTube channel and hit like. If you want to learn more, check out my blog at davidwuunbound.com. Today we're going to focus on the outlook for U.S. monetary policy and its implications, of course. The Federal Reserve, America's central bank, is meeting tomorrow to discuss what to do about its quantitative easing program, with which the Fed has been injecting liquidity into the financial system via bond purchases since the start of COVID. Based on the statements of various Fed officials over the past couple of weeks, it would seem that the Fed is leaning towards accelerating the pace of tapering. In other words, reducing their bond purchases more quickly. I want to talk about why I think this is a done deal and what I think this means for the bond market and the general investment environment in 2022. And most importantly, how you should be positioned to avoid getting run over. But before we talk about the Fed, I want to show you an important piece of the puzzle. What you see on this chart is the quarterly change in total household net worth in the United States. You can see that since the start of COVID, household net worth has been increasing by roughly about $5 trillion every 3 months, which is about double the pace in the 4 years leading up to COVID. Put simply, COVID has put a lot of money in the pockets of Americans. In this next chart, I've divided household net worth by household disposable income. What you see now is that household net worth as a share of disposable income has risen from 700 to 800% over the last 20 months. Not only this is an all-time high, but as you can see, in less than 2 years, COVID created more wealth for Americans than during the dot-com bubble and the housing bubble. Wow. Maybe this is the reason why vaccination rate in the US is the lowest among advanced countries. COVID has been such a bonanza for so many Americans that perhaps some people wish they would hang around forever. Just joking. Rising tide lifts all boats. You don't have to be a particularly good investor to have profited from COVID. Almost everything went up, from the value of stocks to that of your home. The funny thing, of course, is that if you don't own any stock or don't follow the stock market, you would think that things are clearly much worse than they would have been if COVID never came along. What do I mean? Let's take a look at these two charts. The first one shows that the U.S. gross domestic output, the so-called GDP, which measures everything the U.S. produces, is barely back above the pre-COVID level. Furthermore, it is quite a bit lower than it would have been if COVID never happened. The second chart shows that there are 7 million fewer jobs than there would have been without COVID. Put it this way, if a Martian economist were to arrive on planet Earth today, it will take him no time to figure out that COVID has been simply devastating for the Earth's economy. Now, if COVID is so bad, why has it created so much wealth? I'm glad you're at least wondering. It is called financial engineering, or financial voodoo. Over the past 20 months, Uncle Sam sent checks worth trillions of dollars to Americans to help them weather the economic hardship brought on by COVID. As this chart shows, Americans' income got such a big boost from transfers they received from the government that they ended up with more money to spend than if COVID never happened. And spend they did. This chart shows that in September, retail sales rose by 16% in the US from a year ago, compared to just 5% in China, in Canada, and minus 5% in Germany. This spending spree was a huge boom for American businesses. This chart shows that US corporate profit margin rose to 16% in the third quarter, an all-time high. Are you surprised? You shouldn't be, because over the past 20 months, the average American business has made a total killing from having fewer workers on its payroll, but with customers with more money to spend than what they know what to do with. Then we have quantitative easing that went absolutely nuclear, boosting money supply by 40% in less than 2 years. This chart shows that compared to the COVID QE in terms of the impact on money supply, QE1, QE2, QE3 were like baby QEs. QE drove up asset prices by lowering real long-term interest rates to their lowest level on record, with the safest investment offering a negative after-inflation return of -1%. People were left with no choice but to take more risk by going into junk bonds, stocks, and bitcoins, of course. But good things don't last forever, do they? Nor do they come cheap. As everyone knows, inflation has been raising its ugly head. Consumer price inflation hit 6.8% in November in the United States. The last time it was this high, Paul Volcker was still running the Federal Reserve. This chart shows you that the relatively high inflation reading in the US is consistent with the faster expansion of the American money supply. Yes, money printing causes inflation. Don't let anyone tell you different. Even more alarming is what is going on with unit labor costs, which measures how much labor cost is required to produce 1 unit of output. They have been accelerating and are now at the highest level in 20 years. This does not bode well for either profit margin or the inflation outlook as we head into 2022. You might have heard Biden's approval rating has been sinking in the last few months. One key reason has been the accelerating inflation that's eroding the purchasing power of average Americans. Indeed, the so-called misery index, which is just the sum of inflation and unemployment rate, is now higher than where it was at the end of the Trump presidency. It is safe to assume that this is the reason why Biden ended up renominating Jerome Powell as chairman of the Fed rather than going with a dove like Lyle Brainard, favored by the progressives. What you need to know is that this also means that the Fed can now count on the support of the White House as it makes inflation public enemy number 1 in 2022. For me at least, this makes it so much simpler when I try to think about what the Fed will do next. When I'm thinking ahead, I'm assuming that the punch bowl will be taken away in 2022. There's a good chance that the Fed will terminate QE at the end of Q1 next year. What this means is that the market will soon have to buy an extra $120 billion worth of US government bonds and agency debt every month to replace the Fed. That is $120 billion less money going into other assets like stocks. What I'm trying to show you with this chart is that once QE ends, the market will have to absorb about double the supply of US Treasuries before COVID. More precisely, this means for the US government to pay its bills, investors will have to buy $2 trillion of US government bonds, up from less than $1 trillion before COVID. In case you're interested, I'm assuming that Biden's social spending bill does not pass into law or is fiscally neutral next year. I think it's safe to assume that the expected returns of US government bonds will have to go up for the market in order for you to buy an extra $1 trillion of these bonds next year. On this chart, I plotted 10-year US government bond yields against the net supply of Treasury notes and bonds, excluding Fed purchases. What you see is that over the past 2 years, whenever the market had to buy more bonds, yields went up. I think the same will happen in 2022. I am more confident that bond yields will go up than I'm confident about where they will eventually reach. 2.5%, however, seems to be a reasonable target for 10-year US government bond yields. At 2.5%, it will recouple with some of the economic variables like ISM, with which it supported a stable relationship over the past decade before COVID came along. 2.5% also makes sense given this is the median forecast of policy rate over the medium term by the members of the Federal Reserve Open Market Committee. By the way, 2.5% is definitely not an upper bound. If inflation expectation becomes unanchored, long-term interest rates could settle above the nominal GDP growth rate that was the case for most of the past 25 years. Then we'll be looking at maybe 4% plus, bond yields. Right now, the market believes that the Fed hiking cycle will end when short-term interest rates reach 1.8%. 1.8% looks low to me and suggests that the market thinks the US economy will be in a recession soon after that. I don't disagree that the so-called terminal Fed funds rate depends on when you think the next recession will hit. However, the increase of the labor force by 500,000 people in November, if continued, could yet buy this expansion more time. This is why I think it's premature to base your investment about when the next recession is going to come. What is much more clear is that as long-term interest rates go up, investors will require higher earning yields to own stocks. As you can see on this chart, the forward earning yields of S&P 500 has been trading about 300 basis points above 10-year US government bond yields during the past 8 years. This means if 10-year US government bond yields go up by 100 basis points, stocks will have to fall about 10% for the forward earning yields to go up by 1%. To be honest, a 10% correction doesn't seem that bad, especially given the massive gains in stocks over the past 2 years. Indeed, 2018 offers some clues about what may be in store in 2022. After a red-hot 2017 that saw massive inflows into stock mutual funds and ETFs, not unlike 2021, 2018 was a bit of a breather with stocks down 7%. In the short term, however, the fact that market sentiment seems more neutral suggests that perhaps there is a buffer against downside, even if the Fed were to sound hawkish this week. That said, I will be especially wary of January and February that have not been the most friendly months for the stock market over the past 20 years. The reality is that when real yields are going up, there aren't very many places to hide outside cash. As you can see on this chart, Bitcoin and gold seem particularly vulnerable. So what are the risks to my views of higher US interest rates? Risk one, the risk of the COVID booster not being rolled out more quickly. As of last week, only 15% of Americans have received the booster shot, which means the majority of Americans are now without the protection against the pandemic. Risk number two, geopolitical risk. I think that the perceived weakness of the Biden administration is encouraging America's adversaries like Iran and Russia. Last week, Biden sounded very tough. He announced a diplomatic boycott of the Beijing Olympics. He told Putin that he would send arms to Ukraine if Russia were to attack. And he's sending a team to the UAE to toughen the implementation of sanctions against Iran. I'm not so naive to think that Putin and Xi are now shaking their boots. Biden has to do a lot more to turn the table, and Iran and Russia and China will test him individually and together. Indeed, I think 2022 will see an escalation of geopolitical risk. And I think this is the reason why I like actually owning oil majors like ExxonMobil, which are like insurance policies with high dividend yields. Risk number three, I'm worried about Europe, which I view as the weakest link in the global economy, especially given the recent surge in COVID that's hit Europe harder than everywhere else. And given that basically if European rates continue to fall, this will certainly make it more difficult for real yields in the US to basically move higher. In any event, I think this means that a long dollar position against the euro especially continues to make a lot of sense. So what's my bottom line? I think as we head into 2022, I think US rates are going to be going higher, especially long-term interest rates, and this is going to be a problem for the stock market. It's going to be potentially even bigger problem for cryptocurrencies like Bitcoin. For that reason, I would urge retail investors to exercise caution. There's no time better than basically now for being long cash. For everybody else, the more experienced investors, I would argue that you could consider shorting tips as a way to bet on higher long-term interest rates. And if you worry about Europe, you can basically sell some euro against the dollar. If you're worried about geopolitical risk like I do, I think being along ExxonMobil is probably a very good bet. Thank you for listening, and then hopefully see you soon.